Real estate does not appreciate.
All right, you're going to have to defend that one.
Okay. Real estate depreciates. It
Yep.
depreciates fast. It depreciates faster than almost anything.
So today I have Isaac Bennett here with YouAre, and I got to say, I enjoy any time I get to spend with Isaac. Not only is he a wealth of knowledge, but he is a super great guy, super helpful, always willing to talk, give feedback, and share what he knows. So this is going to be a great conversation with Isaac, and I'm just going to let him get into it, and you're going to get to hear for yourself. All right, Isaac, thanks for being here. Always a pleasure, one, to get to hang out with you, but two, glad that we could do it in person. So I always like to let people kind of introduce themselves and tell us what you do, and we'll get the conversation started there.
That's awesome, Jared. Thank you so much for having me. Right back at you. So much fun to connect. We don't get to see each other that often, but it's really fun to do this in person today. So I'm Isaac Bennett. I'm the founder of YouAre, which is a holding company, a brand holding company. And I'll stop the introduction there and just let you ask, because it could go a lot of different ways after that.
All right. So I want to know, I think a good thing to start with was, like, what's your background?
Yeah.
And actually, let's start with what YouAre does. So like the 30-second, 50,000 overview, like what do you do? And then you jump back to the beginning. How'd you get started? What did you do before? How'd you get to where you are now?
Lots of happy accidents. So starting with YouAre.
I've been there.
I know. Starting with YouAre, we are a brand holding company where the idea is anybody who's going to come in as an employee, air quotes, we want to light their entrepreneurial fire. So basically, and I just had a conversation about this today with a young guy who's really awesome. And I said, basically, hey, are you entrepreneurial? Because even if you come in a investor relations role, we want you to have your eyes set on running your own business, within the YouAre sort of metron. And it's been very interesting. We've had a couple of failures of that. So maybe think of like Virgin as like Virgin Atlantic, Virgin Records as a corollary there. Okay.
Yeah. Well, let's brand holding company.
Yes.
What does that mean in normal person lingo?
I think normal person lingo is YouAre is a brand, which is the prefix of all of our businesses. Yep. And then within that, we have the suffixes, which would be like YouAre Abundant, which is our hard asset syndication, real estate syndication. Okay. We have YouAre Launched, which is a venture syndication company. Okay. We have YouAre Royal, which is a royalty company. It's more passive.
Yes.
We have YouAre Home, which is a brokerage business. And then our missional, not-for-profit is called YouAre Good.
Okay, man, I got to say, the YouAre brand that you went with was a whole lot better than what I went with on mine. Because I came across in one of our sermons at church I learned that the word for righteous in Proverbs in the Old English was right wise. So a different word, not the same thing as righteous as in like New Testament or anything. But it was the right way of doing things. Yeah. So when Proverbs says righteous, the right way of doing things. I really like that. I want to incorporate that in what I do. So I have a couple of different entities. I have a holding company. I have my real estate brokerage. I have 5 different entities that use RightWise.
I like it.
RIHTWIS. Well, it's great, except that no one knows how to say it or spell it, and the bank gets real confused because they just see this really weird word and they kind of sometimes assume that the money's it's just the one account.
Yeah.
So. But yeah, so YouAre is much easier to understand, different types of assets and entities. Okay, so that's what you're doing now. Tell me about how you got started in this entrepreneurial side and that journey to get where you are.
Man, that is a question that has entrails that could go so deep, actually, because all the way back to when I was a kid, the very first thing I can remember doing entrepreneurially, it was maybe going to meetings with my mom or dad with the things that they were doing on the side. They were always sort of on the side entrepreneurs trying to make ends meet, right? And I can remember being interested by the idea of something that wasn't necessarily a job. And then I, like so many other people, I read Rich Dad Poor Dad as a child. I mean, I was 9 or 10 years old. My dad had it.
Wish I'd read it at 9 or 10. I think I read it at 24. Yeah, and it did the same thing for me.
Well, yeah. So at the time, I was probably like, "What? Okay, this is cool." I read it again right in high school. I was 17 or 18, and I went, "Oh, I get it." So I thought, I'll get into real estate. I'll be an entrepreneur from day one, and then I spent 16 years in corporate. Jared, to this day, I don't exactly know why. Sometimes we do things, or God takes us a certain way, and we're not sure why, but. I did start buying real estate in 2010, and I
Okay.
started investing in 2005, like shortly after my 18th birthday, buying stocks and stuff, losing all my money in stocks. And, from there, it just sort of grew from that. But I spent 16 years with a W-2.
Yeah.
So it was a long time.
That is a long time.
Yeah.
Okay. What kind of corporate were you doing?
So a couple of things. The majority of it was in mining and manufacturing. So
Okay.
for most of my career, I was traveling around the world setting up dealerships and distributorships for an aftermarket mining company.
Aftermarket
Yeah.
mining
So we
company.
were like the AC Delco of the mining world.
Okay.
So it was a lot of travel, a lot of sleeplessness, but also just incredible experience.
Okay. All right. So how'd you transition out of corporate into alternatives or being self-employed is probably the first step? What'd that look like?
Lots of fear. Lots of fear.
Yeah.
And I think actually part of this journey was having to unlearn the addiction to a paycheck. So I can recall, as I was contemplating this, and it's not like I really needed the paycheck that much, but
Yep.
I was so addicted to it. And a lot of prayer and just a lot of really coming to grips with the fact that I was a very anxious person. And I was very much tethered to the idea of having money, which in and of itself is a bit of a problem, maybe a significant problem.
Yeah.
And so I recall I was in Scottsdale visiting my in-laws, and my wife and I had conceived of this idea and gone through the naming convention of this and everything else. And I remember it was over Christmas, and I was just laying in the hot tub by myself, looking up at and thinking like, if I don't try this right now, this is about almost 5 years ago now. If I don't do this right now, I'm going to be 40 years old and have never become the entrepreneur that God wanted me to become. Like, can I live with myself if that's what I do? And the answer was no, I can't live with myself. And so I said, you know what? We're going to start this, and we're going to see what happens. I had no idea what we were doing. I mean, literally none. We were putting a brand around some of the things we were already doing, which was basically investing, right?
Yep.
And I had a panic attack 2 weeks into starting it. That's how much anxiety and fear and control. It was control. I was controlling my own destiny with my paycheck. Was it rational? It wasn't.
Yeah.
But there was a lot of fear there.
Yeah, that's something that I think I've talked about in other episodes, and then talked about with some mentors and friends.
Yeah.
Is the illusion of control that you have with a W-2.
Yeah, it's the illusion.
And how much different that control actually is from being self-employed.
Yes.
Now the risk tolerance, the risk may be more apparent being self-employed, but so much more of what you do is within your control when you're self-employed.
It's a little interesting because you're correct. It is more within your control. And I don't even like to look at it as control.
Yeah.
I like to look at it as an open highway before you to create.
Yep.
And I don't know if that's control or if it's just opportunity.
Yep.
But the
That's a good way to say
opportunity
it.
set is just endless when you do that. And you're an entrepreneur.
Well.
You know what that feels like, right? Where you wake up every day. And I think the transition for me was, instead of waking up and being afraid, which I did for about 2.5 years or 3 years, I woke up with an open mind to say, what am I supposed to be creating today? And that was the big shift. I like to think that on April 5th, 2021, my life started. It's that different. It is that different.
Yeah, that's great. Yeah, to your point on the creativity and that's really, when I think about the value that I bring to people, it's not my hours anymore. Right?
That's strong.
Yeah,
That's strong.
I don't. The value that I provide is not my time.
Yeah.
It's the expertise. It's the knowledge. It's so many other things, and then the creative aspect is so enjoyable. I got a massage this morning, which I don't normally do.
Congratulations.
But yeah, thank you. I feel great.
You look great. You look fresh.
I look great. I look shiny from all the oils. And so literally, having 80 minutes without your phone in your hand or staring at a computer, I was just able to think about this idea that I've had, this just vague idea that I've had for months and wanting to think about and do something about, haven't done anything about. And I was like, oh, okay, I've got 80 minutes. I can just brainstorm. Yeah. Okay, I can't play with a spreadsheet. But like, sometimes that's not what you need.
You need to let your mind go.
You need to let your mind go. And I came up with so many good ideas. Like,
So good.
I basically came up with a working skeleton of this new idea that, and maybe it's a modification of other people's ideas, right? But something for me.
Are we introducing it on the podcast?
No, we're not. No, lots more has to happen before that would come into play. But the point is like that creativity that I was able to exercise and do, and then I'm leaving the massage, and I'm like, okay, I got to talk to ChatGPT. I got to get it out of my head.
You're good.
I got to get to my brainstorming buddy. And so I was like, I just got to get everything out before I can start forgetting it. And so creativity, I frequently just talk about leverage, and it's not, we talk about leverage when it comes to debt or money and stuff. That's not always the leverage you need. Sometimes it's the expertise and, all that. So,
what's interesting is, I tell people two things. I don't think you ever don't have enough time to go on a long walk or to pray. I have never prayed myself into, and I know this isn't like necessarily a spiritual I don't even know. Is this a spiritual podcast? I have never prayed myself
today, maybe.
Into not having enough time to do something.
Yeah.
And I've never gone on a walk too long to where I then was not super motivated to get everything else done, because work expands to fill the time that you give it.
Correct.
So your 80-minute massage this morning, like, are you behind?
Yeah.
No. Your mind just created something. And what I've found in my life is that when I allow space and time to create, those are the things God breathes on, no matter what it is. There's something about that, we could probably have a whole podcast about that. I don't know that that's where we're going, but
no, I do want to provide investment style education for our listeners, which is what they're used to getting. But we'll sprinkle a little extra today. So,
sounds good.
Okay, so you came out of corporate and you started YouAre right off the bat.
Yeah,
that's impressive. I mean, not so impressive that you started something off the bat, but that the first thing you started is what has carried through.
Yeah, I was just thinking about that yesterday because we're a few months from our 5-year anniversary, and I was just laughing like, well, it may or may not be working, but we made it 5 years.
Yeah.
So
okay,
that helps.
So what were a couple of the first things that you were incorporated into that YouAre brand? You said some real estate. So what kind of real estate experience, and walk me through some of the stuff that you have done?
Yeah, absolutely. So, our very first deals were like most people. They were small condos, single family homes. We eventually put together some partnership deals, and I'm talking really small partnership deals, nothing impressive. And it just sort of, I got turned on to this idea of syndication, which is just a fancy word for putting the pieces of a deal together, which we were doing. And so we started investing internationally in Belize in 2017.
Okay.
And that started getting interesting. And
was that land? Was it vacation rentals? What was it?
Yeah, we were buying land and building vacation rentals. Okay. So both of those things. Yeah. And we our first unit got its certificate of occupancy in late February 2020. So you can imagine how that went. So quite literally, I was watching China shut down as we were getting our C of O and finishing up furniture and everything, and then Belize shut down for 2 years. So that has been, in and of itself, just an unbelievable educational experience. And we've had some success there, and we've had some significant failure there. And it has been incredibly telling what we have learned through both of those, primarily the failure.
Yeah, a lot of times you'll learn a lot more that way.
Yeah, primarily the failure. So in that first year, we did a mobile home park deal. We did a couple of Belize deals and one or two others before really getting into a lot more multifamily in 2022.
Okay.
We learned a lot about multifamily in 2022 as well. I'll pause there. I think that answers your question. We've done a bunch of things since then.
Yeah.
We've learned a lot of lessons for sure.
Okay. Yeah. Because that's, my direct experience with you I actually invest with you and your brand.
Full disclosure.
Yeah, full disclosure.
Yeah.
I don't make anything if you want to invest with him, but I personally place my money with some of your deals, and those types of deals are not what I know you for.
Real estate? You mean the real estate?
The real estate stuff. Yeah. Which I will get into the other stuff that y'all are doing as well, which I think is kind of the stuff that you, the impact style stuff.
Yeah.
But I want to chime in on the lessons learned. I would say some of my most valuable lessons have come from failures. And honestly, sometimes that's the cost of an education, right?
It is.
And so for a while, at one point in 2018, 19, 20, I was buying and fixing and flipping a couple homes here or there, 3 to 4 homes a year. I'm a real estate broker. Stuff would fall in my lap. And I was making money on all of them, and it was great.
Yeah.
And then I was like, you know what? Like, I want to start up another line of business for myself. I'm going to actually start advertising for cash offers to buy homes.
Interesting.
Found an agency that would run Google pay-per-click stuff, and I started dropping $5,500 a month on pay-per-click ads. In reality, I think it was about 50% on the ads and 50% was their management fee. But I bought one home in early 21? It took me like 12 months to do the renovation. Maybe no, it was early 22. I closed on it early 22, and the market turned.
Yeah.
And so I spend about $70,000 in advertising. Let's take it down to 50. Make the numbers round. 50 on advertising, bought a single property, and lost 20 on it.
Yeah.
Because of the market, because of some repairs. And it took me $70,000 to realize I should not be a cash offer guy.
Yeah.
I'm not wired for that.
Yeah.
So that also helped me realize that I wanted to move towards more passive investing. I wanted to do my job that I could produce a good income on and invest that money instead of being, essentially a flipper.
Yeah.
Because that's a job.
It is a job.
It's not investing. It's a job. But
yeah, the lessons, they're interesting. It's kind of funny because we do know each other in the context of more like venture investing, right? But I think real estate is foundational business. Mm-hmm. And you want to get into the lessons?
Get into the lessons, yes.
Learned. Real estate does not appreciate.
All right, you're going to have to defend that one.
Okay. Real estate depreciates. It depreciates fast. It depreciates faster than almost anything. Every single thing that you touch in a home loses value. The only thing that you could defensively say appreciates is the ground underneath it, the land underneath it.
Okay.
And the land underneath it can depreciate or appreciate, and that's generally because it's absorbing the economic output, plus or minus, of the things in its near proximity, right? That it's proximate to. And that can be wonderful. But the things that you build on top of it always depreciate. Now, the thing about real estate is it has almost the most direct, if you add value within the inputs of this, if you're building something, if you're renovating something, and you're increasing the net operating income. The 1-to-1 ratio of here's the thing that you created value, here's the output. It's very predictable.
Yes.
So if you can dial in a system that says, I know I can take this from $1,000 of net operating income a month to $2,000, the market will pay you for that.
Yes.
For that value created, right? But that is the alpha. That's the gain, right? Cash flow comes and goes. And there are lots and lots and lots of people who will basically tell you that cash flow is king. Cash flow is nice, but it is not something you should predict, right? Because it is very challenging if you have a big capital expense. Sure, maybe the accountants tell you, oh, well, capital expense is over here. Well, yeah, that's not what my bank account says.
Yeah.
So, ultimately, free cash flow is the thing that doesn't lie, and capital expense is the same as anything else. So I think it's one of those things. The other thing is identify value not by cap rates, but by price per square foot in a given market, and know that niche extremely well. Asset class niche, neighborhood niche, what corner you're on, literally which direction it's facing. Do you have easy in, out? There's probably literally 1,000 different things that you could analyze. But at the end of the day, you're going to need to understand what you're paying on a price per square foot basis as opposed to some sort of cap rate. Another thing I would learn is if anybody shows you a pro forma, make sure that they know that you know that they're full of crap. Because they just mean very little. Very little. And if you're an investor and you find yourself obsessing over a pro forma, you probably don't know what you're doing.
I hate commercial brokers pro formas. There's never any, like, even with their own data, I'd feel like there's not enough to justify what they're telling you. Like their own pro forma that says something, says, okay, where'd you get these numbers?
Yeah, and I think it's a little hard to even have the conversation because people are like, well, then where do I plant a flag? How do I analyze a deal? Well, make sure you have a very clear understanding of how the deal is capitalized, and that's just a fancy way of saying where's the money coming from?
The money coming from?
And then even more importantly, who's getting paid first.
Yep.
So if you can define those two things, and then you can understand how an operator, if we're looking at this purely from a syndication standpoint, right?
Yep.
I mean, if you're your own operator, I think some of this is still helpful.
Yeah. Now we want to talk to the LPs here.
Okay, yeah. So then if you can understand exactly what inputs are going into the property and how that value is added, how net operating increase, or like we do a lot of land deals, or how the land is being increased in value.
Yep.
And then you can understand, okay, if $100 turns into $200, who's getting paid and when? If you can understand those pieces, you're so far ahead of most fancy waterfalls and pro formas and everything else.
Yep.
You know, so I think it's just absolutely critical to understand capital stacks. The biggest mistake I've ever made in real estate was I invested with a celebrity, sort of real estate celebrity promoter, and with a famous brand, world famous brand, and I have yet to be paid on a cash deal. Resort's doing great. 5 years later, I've yet to be paid. Why? Because I'm in the wrong place of the capital stack. It's that simple.
Yeah. You know, I gotta say, some of the guys that I feel like are the smartest guys I've talked with, the advice they give is the simplest, and that's something that I would say goes into that category of one, who gets paid in what order, and where the value comes from.
One other thing I would tell you, and this is maybe counterintuitive, don't ever invest with an operator who is only taking a small part of the deal. I see people on LinkedIn or whatever else be like, oh, I'm using my LP dollars to get 95% of the carry, and I'm not doing it if you won't give me 95%. I'm like, any operator that's going to give you 5% is going to lose all your money, all of it, because he's doing it for the fees. He doesn't care if the deal succeeds or not. He's doing it for the fees, he or she. And so, I mean, if you can find an operator that operates well, has a track record, is honest as the day is long, that's the most important thing, and wants a healthy chunk of that deal, that means they are investing alongside you for the carry, for the promote, right? And that's what you want. You don't want an operator willing to work for 10%. You don't, trust me.
Yeah, that's something that I hear consistently is you need to make sure that incentives are aligned.
Yeah.
And understanding what the incentives are and worth it. Yeah. Because to your point, if there's not a big enough promote or carry, or the syndicator doesn't get a chunk of the deal for running and doing the deal, if that's not there, then why is he doing it?
Yep.
And you said it, fees are the likely culprit, right?
Yeah, and fees are not a negative thing.
Correct.
People need to feed their families, and they need to keep the lights on, they need to be hired the support. But you should really dial in on what they are, and there shouldn't be more than one or maybe two unique fees, because then you know they're saying, here's my syndication fee. This is what it does. That's good. Everybody should have that. If you've got 4, 5, 6 different fees, that's a huge red flag to me.
Yep. And what we're talking about for anyone less experienced right now is you don't want a syndicator who is incentivized to put a deal together and then doesn't care how it goes, and is incentivized to put another deal together and another deal together, and they make their entire living off of
management,
off the fees of creating the deal, and they don't make any money on a successful deal.
So right.
Okay, so great. All right, let's jump in. So you had the real estate experience. We've talked about some lessons you've learned. What other stuff are y'all doing in the YouAre brand, so we can kind of touch on some of that education too?
Absolutely. So we have another, I think it's probably interesting to tell the story of how we got into it. We have another agency called YouAre Launched.
Okay.
And YouAre Launched stemmed from a good friend of mine. He's actually on our board, our YouAre board. He called me and said, hey, do you want to raise money for robots? I said, no. Nope. He said, okay. Hung up the phone. 2 weeks later, I get another call from him. He said, hey, we're having a launch party tonight for Pringle Robotics. I'll see you there at 6. I said, I'm not coming, Dean. He said, yeah, you are. I said,
now, was he on your board at the time?
Yeah.
Okay.
He's a close friend.
Okay.
Like,
yeah.
Yeah, he's just being funny. But he's like, I'll see you there. I'm like, oh, whatever. He says, this is a launch party. It's a local restaurant that my friend owns, and it's 5 minutes from my house.
Yeah.
It was a setup. So I walk into this. It's like 6:15. I'm like 15 minutes late. I'm on the phone. I think I'm walking into a party with 100 people there, and the restaurant is shut down. And there's one table. There's 5 guys sitting at it. And there's one empty seat. They're waiting on me. I'm like 15 minutes late. Little did I know that the CFO of Caterpillar, like Fortune 10 company, was sitting there waiting for me. Did not know that. He's on Pringle's board. And so I sit down and Sudhir Saja, the founder of Pringle, starts talking. Lovely guy, wonderful guy. I immediately like him.
Mm-hmm.
And like 10 minutes after he started telling me the story of his startup, I found myself saying, how do we help? And that's what launched YouAre launched. It was the recognition that the way people syndicate real estate could effectively be done the same way in private businesses, and that there's millions of businesses out there that could use this type of work. Nobody really does it. I mean, you've got sort of venture investing over here, which is one thing, and you've got private equity over here. Frankly, both of those are a complete mess. I'm not just saying that. I firsthand see how much of a mess both those systems are. And there's this massive space, this massive void to do what we're doing. And I'll be honest, Jared, I haven't taken a new deal in 2 years. I haven't called you and said, hey, do you want to invest in something in 2 years? Why? Because the 5 existing deals that we have, first of all, they've gone extremely well, but they take a lot of work.
Yep.
And they're growing businesses. And anybody that grows a business knows that it never really stops. So we've had a couple rounds in each of these, and every one of them has gone well, which might be the wrong thing to say when we talk about the risks involved here. But that's what started YouAre launched. So, we've got 5 deals in that space. I'd be happy to talk about any of those.
Yeah, well, I want to start with first, maybe like the lay of the land. So you've mentioned venture, you mentioned private equity.
Yeah.
How would you describe the differences between those two things and then syndications?
Yeah, in general, I view private equity as groups that are going out there and trying to generally buy a controlling interest in a deal, right? And they've all got their own spin. They're almost always coming with huge leverage. So they're going to come in and put a sweater vest and some leverage and a tech stack on something and say, here's a newfangled business. I'll give you an example.
Yep.
I heard that if you call a plumber and they show up in a wrapped van and an iPad, you should immediately run the other way.
Yeah, private equity's moving into the plumbing space, the HVAC space. Yeah.
And if a guy shows up with a dirty shirt and scruffy beard, he's probably your guy. and that's sort of private equity to me, not to be too harsh, but like I just don't see a lot of value being created in private equity. I see a lot of
value extraction for themselves.
Financial engineering and machinations to really extract value for themselves. They're good at it. Some of them, they're good at it. They can do that well. That's fine. Venture, I view a little different. Venture comes from the place of saying, hey, there's a lot of seed investments, so it's more ideas based. Hey, we have an idea. I've got this new software. I've got this new, widget. I've got this new patent that I want to take somewhere. So if you go all the way to the beginning, you'll have people that seed 100 different ideas to see 3 of them succeed. And then you'll have a series of rounds. You'll have your seed, you'll have your series A, you'll have your bridge round, you'll have the B, another bridge round to see how they denote all those. I think it's a lot muddier than they want you to believe. But what that basically is the idea of watering winners and cutting losers, right? And they try to water these companies long before they are successful and long before they cash flow. And I think you'll see a lot of these companies not cash flow. Many of them never do. But venture has supported a lot of the biggest successes that you see out there, a lot of big public companies. So it's not like it doesn't necessarily work. I think it generally works for everybody but the founders. So if you're a founder, like lots of times that you will get money at a time when you don't necessarily need it, or it would be better for you to be bootstrapping and using the side of your brain that has to create and iterate through a bunch of very challenging things. Or it comes with a series of tethers that ultimately ruin your life. And so there are successes out there. I don't at all. I'm sure there's venture people that are listening to this right now. They're like, oh, that's terrible advice. Maybe. I've just seen a lot of the problem of that. And there's a lot of businesses that just simply aren't going to attract venture dollars. They're just not. I have a manufacturing company. I think you might be in that deal.
Yep.
They were never going to attract venture dollars, but it's an unbelievable business.
Yep.
And they're more than doubling every year so far.
Yep.
But they're probably still 2 or 3 years from one of those types of groups coming at. PE could get interested soon. They're not going to go that route. But so there's just, you also have, I think, both PE and venture like to say, hey, we look at 1,000 deals and we might choose one. Well, fantastic. Unless you're a unicorn, like that's going to be very discouraging to even think about starting the process. So I'm going to go 6 months to get turned down. Like I can go try online dating if I want to do that. So we sort of exist to say, let's look at a lot of stuff and let's give more groups chances. I say that fully hypocritical considering we haven't taken a deal in 2 years. But yeah, that's kind of how we look at it.
Yeah, I do always find it funny, not from a negative perspective, but how people do like to tout how many deals they look at
and don't do.
Yeah, it's like, okay, well, what does that mean? Is that just I don't know, is it a vanity metric? Probably. That's my term that I like to use in real estate. Yeah. Like, because real estate brokers like to talk about GCI, like gross commission income, like they're all vanity metrics. It's how much money to make at the end of the day.
Yeah.
Like, how much money do you keep? Do you take home?
Right.
Now in y'all's world that might be a little bit different, but at the end of the day, that's what's most important is, are things successful? And in business, success is measured a couple of different ways, and one of the main ones is profit.
It's still true.
Yeah.
Amazingly, it's still true.
Amazingly. Okay, so launch was started with Pringle Robotics.
Yes.
I'm going to give y'all a little bit of a spoiler. I took a photo of a Pringle Robotics robot in a Quick Trip the other day and forgot to send it to you.
Oh, you did?
Yeah. Funny. I've got it on my phone. Yeah.
I've had a few friends send me them recently because they have a nationwide contract for cleaning bots in Quick Trip.
Yeah.
And several other significant companies. They're crushing it.
Yeah, I walked out of the bathroom, and if anybody's familiar with Quick Trip, there's like, you got the hallway with the bathroom, there's all like the cleaning equipment and all the other stuff, and I walk out and there's this little 20-inch tall R2-D2 in the corner, and I was like, oh, it's a little robot. I was like, oh, I thought somebody else told me that Pringle was in Quick Trips, and I look around, I look on the side of it, and it says Pringle Robotics on the side.
Yeah.
So that's pretty cool. I bet it cleans those floors better than their average Quick Trip employee used to.
Well, yeah, it's about efficiency certainly, but it's also about the fact that our sanitation levels in facilities like that had gone so far down because they can't hire for it. And it's not like, oh, there's a 5% shortage. I don't know the actual number, Jared, but there's like a 75% shortage of that type of hiring. You just can't hire janitors or people that'll do it. So these little bots fill the void there, and there's thousands of them out there running around cleaning floors.
Okay, yeah, so that's great. And so really, I guess you were asking me earlier, like, hey, what do we want to talk about? I primarily want to talk about your launch.
Yeah.
I think that's what I primarily want to hear about, and the risk factors, the thought processes, how you vet things, which, might be a little self-serving to talk about, but also educational for the listeners. Like, hey, if I'm looking at something that is entry level or growth stage for businesses, what are these questions I need to be asking, whether it's with you or with somebody else? So I'm invested in Firebox.
Yeah.
There was another one I heard y'all talk about in an update, and I was like, oh, that one sounded super interesting. But yeah, so tell us a little bit about a couple of the different launch brands y'all have partnered with.
Definitely. So we've talked, Firebox, I think we can say, is next gen firefighting equipment, custom patented firefighting equipment. We'll leave that there. You can go look at it. It's super cool. Honestly, they've got a ton of great TikTok videos, growing rapidly. There's it was originally set up for firefighting, but they have use cases across construction, mining, etc.
Agriculture,
agriculture, absolutely. There's a bunch of different things that they're doing. Very cool.
Yep.
Sean Henry is the founder there. He's a genius. He is a design genius. That's one of the things we're looking for. Is we're looking for somebody that has a clearly defined Michael Jordan-like skill in something.
Okay.
I do not have any Michael Jordan-like skills.
Yeah.
But here we are.
I'm a people person.
Yeah. That's a great skill. Great skill. We've talked a little bit about Pringle. That's pretty obvious. You can look at them, and they're growing nationwide, actually internationally. Two others that I'll talk about in a little bit more depth. The first one is called Elysium Therapeutics, which you're very familiar with. Yep. Elysium is, you want to talk about Michael Jordan of something. We are friends with Dr. Tom Jenkins, who is the Michael Jordan of chemistry. And he looks like Santa Claus. So we call him Biotech Jesus. He heals people with biotech. So Tom is one of the greatest guys on the face of the planet, and he just happens to be one of the world's best chemists. I think he's going to win the Nobel Prize for what he's done here. Things I say and can't prove. But he has developed through Elysium two products. One is an opioid delivery mechanism system and one pill that you can't overdose on. So you could take a whole bottle and not overdose. It also keeps you from the sort of euphoric up and down nature of the way opioids work. Now you say, oh, well, that's great. Well, it's the first ever time in history this has been demonstrated.
You mean it's not a little candy coating that slows down the absorption rate?
Yes.
I've seen a couple of those documentaries. Yeah.
Purdue Pharma lied about every single thing that they ever did.
Oh my gosh,
and created this epidemic. And honestly, they've killed millions of people.
Yeah.
And that's just the frank way to say that. That's why this opportunity exists.
Yep.
It's also why the number one killer of adults in America, 18 to 49, number one is opioids. Number one. Not heart attacks, not car wrecks, not murder. It's opioids.
Yep.
And so what Dr. Jenkins has created there is addressing the root of the problem, which is don't get addicted in the first place.
Yep.
Because I don't know if people realize this. Addicts don't want to be addicts. I've literally never met an addict who's like, I love my addiction.
Yep.
And opioids are one of those things that are silently addicted to until they're not. Until they either die of an overdose or they're on the street. And most of the people that you see on the street right now in the cities that we live in, opioids. So it is an epidemic of almost unfathomable proportions. Yeah. So that product from Elysium, it addresses the root cause, which is don't get addicted in the first place. I could go into a lot more detail there. I'll pause there. The other one is addressing the fruit, or very poisonous fruit of this, which is if you've already overdosed, how do we save your life? Many people will be familiar with Narcan, which is basically a rescue agent if you have overdosed. Narcan is a great product. They've done great work. I have nothing bad to say about it other than the fact that it doesn't work anymore.
Yep.
It will work for a generic baseline heroin or opioid overdose, but for fentanyl or something like that, which is where the majority of these overdoses are coming, it will not work. So Super is the product, and it is designed to take you out of an overdose and keep you out of it long enough to get you into critical care. Several hours that you need for loved ones to come around you and do that. So they have these two products, and they're at various phases of the clinical trials with the FDA. The first one, O2P, the overdose protection agent, has been proven in humans already, which is amazing. But just to get a little more philosophical about it, when I was first introduced, I think by a mutual friend of ours, to Elysium several years ago, it was introduced through the lens of, hey, this is a huge problem, go help them. Okay. And then I did nothing with it. As we do sometimes, right?
Absolutely.
6 months later, I run into my friend at another event, and he says, hey, what did you do with what I introduced you to? You're supposed to do something with that. I said, I didn't do anything, man. He's like, well, great, get on it. So I did. I took his advice, and we got on it. And I can tell you, like, people talk about purpose and all these other things. If Isaac Schaefer, my co-founder and partner, if our life is, if we make no impact other than helping Elysium get their stuff to market, it's enough.
Yep.
It's enough. Our entire business, we have said on a number of occasions, like, if just this one thing works, that's why we were supposed to do this. Because there's hundreds of thousands of lives a year on the line here.
Yeah.
Let me pause there and see if you have any questions before I go into
I think a comment first is, I won't get too tinfoil hat on here, but I'm not a huge pharmaceutical industry proponent.
Yeah.
And so when I first heard you talking about it, I kind of like checked out.
Yeah.
And then I was like, oh, wait, what are they doing?
Yeah.
And you realize that, okay, well, this isn't an opioid, because I've tried to describe this to a few people, and their first thought was that it's just another opioid. No, it's not an opioid. It's a delivery mechanism for drugs that are already going to be given.
It's already on the market.
It's already on the market. It's a delivery mechanism.
It's a delivery mechanism
that prevents overdose. And I think what you had said previously is it shortens shelf life, if I could say that the right way. Is that still accurate, or maybe not?
Well, they actually had a third technology.
That was separate.
And here's what happened. So they had a third technology which they could actually program how long it would be active for before it went inert. But what they found is that their delivery mechanism system actually tapers off so much slower than a traditional opiate like hydrocodone or oxycodone that they only have to give you one pill a day. So what that means is that they can give you a full week's dose, which is 7 pills instead of like 36 pills.
Got it.
So they don't really need it to not have a shelf life anymore because they've already cut it down so much. So they basically just shelved that technology and said, okay, it already works that way. So yes, you're correct in that assumption.
All right. So a delivery mechanism that I'll say just so I don't say like it makes it totally unabusable, but significantly reduces the ability to attempt to abuse it.
Yeah, absolutely.
And then something that saves people out of an actual overdose.
That's
so
the second
for
product.
me, it was, okay, well, these are actually things designed to help people
Yes.
who are being hurt by pharmaceuticals.
Yeah.
But by using the pharmaceutical industry, right? You're going to have to develop something. So that's what made me actually decide that it was worth our time and effort to look at, because it was really cool and it was impactful, and the growth potential on it wasn't bad.
Yeah. I don't even know if we want to get into that.
No,
but
we don't need to.
That's why you're in these deals in the first place, right? It's 'cause
but
they do have huge upside.
Yes, they have huge upside. Obviously, something like Elysium is, particularly when you first brought it to us, a significant risk of total loss of capital.
Absolutely.
Right? That's what goes into some of these types of investments.
Yes.
Okay, so a couple others, and really maybe it's more of a, when you're doing these type of launch things, what are you looking for that makes these interesting?
Well, I think there is the qualitative and then there's the quantitative, right? And just starting on the quantitative, since we were kind of already there, one of the things that I heard many years ago, which has always stuck with me, that if you're going to make an investment where the downside is absolute, where you could lose all your money,
Correct.
the upside better be life-changing. And so when we go into any of these deals, we tell people the downside is absolute. So first and foremost, position size this in such as to where if you lose it, you say shucks, not where you lose sleep.
Yep.
This is a shucks investment, not a what have I done investment. And we are just so adamant about that, because you must. The odds say that you're going to miss on more than half of these, probably greatly more. Now, we've been very blessed and fortunate as to where everything that we've done so far in this has gone really well. I don't necessarily anticipate that always being the case.
Yep.
And if we took more deals, that would not be the case. But we look at this and say, okay, if we're going to get into something like this, we're not trying to double people's money. This needs to have at least 5x potential, at least. Something like Elysium, you probably don't even do it if it's 5x that you're shooting for. On Elysium, you're shooting for 15 or 50 or something ridiculous like that. X, turning $100,000 into 5 million or something crazy like that. That's what you're looking for. So if the downside is absolute, the upside better be life-changing. And I will tell you, if you're going into real estate syndications, just as an aside, the downside is absolute.
Yeah. That's when we've talked about it.
Yeah.
And on the show with multiple people.
Yeah.
Is while the value of real estate may never go to zero, your equity might.
It can
It's the
go
fastest way to say it. Yeah.
Real fast. Yeah, absolutely. There are certainly, and you know what? Right now, there's a lot of properties where the value of the property is zero or negative. The carrying costs are much greater, and people would pay to unload it. And I think you'll see some of that still coming. But, so that's sort of number one. And then, so make sure that the juice is worth the squeeze per se. You're looking for tremendous upside. And then more on the qualitative side, we have a mandate within our business, YouAre launched, that it has to support human flourishing. And that's a little bit vague, maybe, but we have to be able to look at it. Like, just for instance, I'm not going to go help Pfizer one of these days, to your point. Like, I don't think they're supporting human flourishing. That might not be quite fair, because I think they have some things that are. But in general, you're talking about an industry with a lot of bad actors.
Yep.
And a lot of good actors. But it can be very difficult to tell the difference. I can tell you beyond a shadow of a doubt, Greg and Tom, they're good actors. You know what I mean? But it has to support human flourishing. Putting out wildfires, that's supporting human flourishing, right? We feel good about that. We're looking for founders who are all in. I'm not looking for a dilettante, somebody who is doing this on the side, somebody who doesn't have expertise, somebody who has an idea. I'm looking for somebody who has been chasing something for decades or years at least, and saying, like, I'm going to put everything on the line to go get this thing done. Because as a business owner, Jared, you know that if you don't have that mentality, you might as well not even start. So we're looking for that, and I think everybody's looking for that. Beyond that, we're looking for talent. Somebody that we can say, you are a star at what you are doing, and we want to come alongside you.
Not just diligent hard worker.
No, not just that. A star. We're
Yeah.
looking for a star. We're looking for a moat. Do you have either a huge lead or protectability on what you're doing? In Elysium's case, they have a patent moat They have defensible in court. Hey, you can't sell these products for 25 years because of what we've done.
That's what I was going to ask. How long are pharmaceutical patents for?
Yeah, they vary just depending on what they are, but up to 25 years. And then there's, when does it come to market? When was it filed? Et cetera, et cetera. And so usually you have what's called a thicket, where you've got a series of them that have been done at different tranches. So you've got different things to defend. You want to make it as hard as possible for somebody to overcome them. Or a series of products where the market is so large that it doesn't matter. If you create the product, you're going to sell it. Renew Environmental would be an example of that. What Renew does, just as an example, they have the world's only emissions-free plastic to oil pyrolysis. That's a lot of words to say. They take waste plastics, stuff that would go into a landfill, and leach into the ground. And
that's the one you talked about that I hadn't heard before.
Okay,
that I was like, oh, that's super interesting.
Yeah, so we build modular plants. They're about 4,000 square feet. Not big, not big. 4,000 square feet. We put plastic in one end, and we get ultra high quality naphtha out the other end. It's basically jet fuel. What we're currently selling it for to a super major company is virgin polymers. Basically, they put it right into their cracker. They create new plastics. It's fully circular, right? This stuff sells for between $200 and $300 a barrel. So this isn't West Texas crude, right? This is coming out, it looks like canola oil. So we are, instead of putting plastics in the ground or wherever else they're going to end up, right?
Let them sit there forever.
Yeah. We are actually completely replenishing them back into the native source, which of course leaves oil in the ground for future generations and keeps it out of the landfill. So it is, from a public good, common good, everybody can get behind this idea, right? And we're not putting any, terrible emissions out into the environment or anything. So, that's human flourishing, right?
That does check a lot of boxes.
Checks a lot of boxes.
Green people, the oil people,
all the people, the investment people. So that's a super analog business. You put a machine up, and the plastic goes in one side, oil comes out the other, and then it comes down into something like unit economics. So if we're talking about the quantification, how long does this machine take itself to pay itself back? Well, that takes about 8 months. That's pretty good economics, right? So those are some of the things we're looking for, and then just that buy-in, that commitment that we know that hell or high water, the people that are running these things are going to be here in 5 years still running them.
Yep. Okay. All right. Let's jump base level for LPs right now. We've talked about some of the different types of things that you're doing. I'm a part of a couple of them. I'm just as an investor. When someone like me hears someone like you talk about these, really cool things, fairly novel. A lot of what you're doing, pretty novel. So it's easy to get excited about it.
Yeah.
What are the barriers that someone should place in front of themselves before they choose to invest in something like this?
The very first one that I would always tell you to look at is place a barrier of position sizing.
Yep.
And, there's a book out there called Thinking in Bets, which is interesting because I think Annie Duke wrote it.
I haven't heard of it. I'll have to listen to it.
Yeah, it's not that well known. Annie Duke is a professional poker player, and
one of the smartest guys I know who gives him some of the best advice is a former professional poker player.
Yeah, they're brilliant guys. They're a combination of people who know people and they know math, and that's a dangerous combination because most are one or the other. So you got to watch those people. But no, thinking in bets, and there's been some studies out there that have shown that returns are most tightly correlated to simply how you've position size, not what asset class you've been in, not what you're chasing. Not concentration, not indexing, it's position size. And that's very counterintuitive, but when you really get down to it, there's some very logical reasons why that is. So the first thing I would say, particularly when you're looking at venture, although for the sake of this conversation, I would put real estate right back in that vein. And it's not just make sure it's really small. It's sizing it proportionally to the understanding that you have of a project, sizing it proportionally to the upside, also, of course, to the downside. More important, right? First rule is don't lose money. But then also making sure that if it does hit really big, for instance, if Elysium goes 100x, Lord willing, doesn't matter. Like, okay, yeah, you could come and put $1,000 in this. You can't because there's minimums. You could put $1,000 in it, but then if it goes 100x and you made $100,000, you're going to spend the rest of your life going, why did I only put $1,000 into it? So sizing it to a place where it matters and you're going to follow it. You're going to learn from it. You're going to edify from it. And it's going to change your life if it hits really well, but not so significant to where it's more than a shucks investment if it goes wrong. Does that answer your question?
Yes. First barrier. First barrier.
Position sizing is the first barrier. Beyond that, sadly, the answer is do as much due diligence as you possibly can around the ethics of the people putting it forward.
Yep.
I do not care if an operator loses money. I absolutely care if an operator steals. And believe it or not, I've been stolen from in this business by operators a number of times.
Yep.
And so the ethics of the operator are a non-negotiable.
Yep.
And if you get even a yellow flag, go the other way.
Yep.
Even a yellow flag, go the other way. If they say something that just makes you go, I'm not sure about that from an ethical standpoint. Not necessarily if you agree or disagree with their principles, or not necessarily
decision making,
or their politics, or their decision making, or what direction they're taking the company. All that can be thought through, and you can have disagreements. But their ethics.
Yep.
If they're unethical, just don't even consider it. No matter what they're selling you or what that greed gland in you feels like, don't do it.
Yeah, I don't know if I've talked about this prior. I might have touched on it, but were you familiar with the Pickleball Club investment?
I am vaguely familiar, but I'd like to hear the story.
So I invested through a couple of people I know, and they were, one of them was invested in it personally with his own funds, and then brought it to some other individuals. There was some minimums, so we all kind of pooled in and hit the minimum together. And as I was doing my due diligence, I was like, okay, well, they're buying the land, they're building the buildings, they're going to sell this, kind of like country club style membership for pickleballers in Florida. Okay, that's got to be like the prime place for pickleball players.
And it's a hot thing.
It's a hot thing. It's going, okay, great. I think this looks great. And I'm doing into my math. I'm like, okay, well, at the end of the day, if the clubs don't work out, they have these big box structures. It's a warehouse. They own the land. They can sell it all. Okay, great. I think worst case scenario, I probably get my money back, which is that's not a good worst case scenario, but it's better than total loss, right?
Yeah.
What I didn't do a whole lot of due diligence on was the individuals.
Yeah.
And I don't know and I haven't, because of where we're at, I was like, I'm not going to waste any more time on this. I don't know if I would have found anything, to be honest.
Yeah, you might not have.
I might not have. But what ended up happening was, one, end of the day, the whole company's like, they're liquidating assets right now. Mm-hmm. So I'll see how much money I get back. Mm-hmm. But two, the three partners, the three GPs, were essentially loaning the company personal funds and charging big origination fees.
Great.
And then putting their money first in line because it was debt.
Yeah.
So a lot of mixing and mingling of
and there's the capital stack thing.
There's the capital stack. Yeah. All of a sudden, I was getting bumped down or up the capital stack, however you want to say it.
Yeah.
I was getting bumped back in line.
Right.
When I'd invested in maybe like the second round. Yeah. But when they lend themselves money, all of a sudden their money's first in line. So, the ethics. And again, you might not always find this out.
You might not.
But I realized that, and I kind of knew this, right? But I just didn't do it on this deal.
Yeah.
Was that it was the individuals were a big part of the problem on this deal.
Definitely, Jared. And that's a great example. And the one thing I want to say is, like, don't tell an operator, oh, I trust you, so I'm going to make this investment. I've seen very trustworthy people lose money in investments.
Yep.
Things go wrong. It's business. It's life. That's what happens sometimes. Yep. So you need to understand that they're going to do everything in their power to protect your capital. Mm-hmm. And that is going to be on the top of their mind at all times. It does not necessarily mean it's going to go well. Mm-hmm. However, what you just talked about is unethical behavior.
Yep.
And that's where you have to let your intuition tell you, are these people telling me the truth? And if there's even the remotest check of that, just don't do it.
Yep.
Just don't go into it. If you feel that way about me, don't do it. I don't want somebody in who is questioning my motive, my ethics, right? Business is hard enough as it is. It's hard.
Yep. I've had some clients occasionally that I could tell they're very frustrated with me.
Yeah, it happens.
And you lean into it, and if you lean into it and you work through it, most of the time you come out the other end and everything's okay.
Yeah.
But if it's someone that just from the get-go, just isn't going to trust you, it's just not worth the effort.
It's not. And a lot of times, and people can project, right? I mean, there's something in themselves they don't trust, and they're like, oh, you're a man. Like, I can't trust you. It's like, okay.
Yeah.
So, but I think that's the very first couple of things that I look at. And then from there, Unit economics are really important,
Okay.
both on the venture and the real estate side, and understanding that.
Dive into what you mean by unit economics.
Sure. So Renew's a good example because it's very analog.
Yep.
Here's a machine. How much can it make per year to pay itself back? It works out well. There's a lot of problematic things that can be cured by unit economics. Like a really great manager that is managing a business with terrible unit economics, the unit economics are going to win. And sometimes you can have a really terrible management team and has a company with really great unit economics, and the economics win. So it's like it's very important to understand the top and bottom line for what you're doing. Now, there are great businesses. I'll give you an example. Costco, their top and bottom lines are minuscule, but they are so incredibly efficient. They have such a great brand, and they have such a rabid following that they can make it work. Most businesses aren't like that. Most businesses, you need really fat, thick margins, and that's where unit economics come in. So one of these machines, maybe we'll spend, I'm going to use really round numbers, we'll spend $8 million building the machine, and it can make 12 to 14 million per year. And it's like stainless steel stuff. It should last for 40 years, right? So over the longer term, no matter how dumb we are, and we have our moments, that machine's going to go over there and cook and make oil. And the other thing is this product going? What's the Lindy effect? Like, is this product still going to be here in 10, 20, 30, 50 years? Will it remain? And oil's going to remain.
Correct.
So that's sort of looking for the Lindy in a business.
Okay. All right. So we've got some of those numbers. Why don't we get into, I want to say kind of the team. You've already discussed the ethics, right? And now what about kind of like what you've done, right? Like you're partnering with some of these founders, right? When it comes to the structure of the investment, what are some red flags or important questions that these investors should be aware of or think of, or they should be asking or looking for, right? It's kind of a really vague question, because these deals are not going to look, they're not always going to look just like your typical real estate syndication.
Yeah,
right?
they look very different. Most of them are not pass through, which real estate typically is for the depreciation. These are mostly not pass through.
Yep.
Yeah.
So what and each one of the deals you mentioned could look totally different.
They do
as well. So
they all do.
What are range of these more venture style investments? What's the range of structure that these will look like?
Yeah, it's a good question. And off the top of my head, they're generally all corps, right? They're all C's. And I think the thing that you
C corps, we're talking about.
Correct.
Okay. Gotcha.
Yeah. I think the thing that's important to remember is that, in many cases, they're not structured as a pass-through. Yep. And that can be good and bad. I am a fan of illiquidity. I think that liquidity is one of the biggest lies on the face of the planet as far as, hey, look, this is a liquid investment. Like, that's a good thing. Yep. It can be a good thing, and it can also play to all your worst instincts as an investor. The second you feel, you wake up and...
I want to pull it out, and now...
I'm done.
And now the business is suffering because they offered liquidity.
That's one example. Okay. Or the business is doing amazing, and you had to go repair your car, and that $5,000 that you just could pull out just like that quick. Most of the biggest mistakes people make are errors where they didn't let something germinate as long as they should have.
Well, one of our last interviews, Christine Cranley, big into the cryptocurrency, primarily Bitcoin. She had a friend, it might have been a brother-in-law or someone, I don't remember. Go back and listen to it. But bought Bitcoin at 100 and sold at 400 and was proud of himself.
Of course.
At the time.
And it ruined his life now, probably, right?
It's
like, exactly. So, I think when you look at these things, you need to make sure that you are okay with the duration of what this might be.
Yeah.
And duration's hard. Even as a founder, as an operator, for instance, on our real estate, we do land deals. We entitle and uplift land with zoning and other things for data centers. And it's very hard to know how long it's going to take because you're dealing with a lot of other people. But we tell people, you need to be patient here because it's going to take a while. And that's the same on the venture side, where you have catalysts out in the future, but then you're predicting the future about how long it's going to take. For right now,
forget it.
It's a set it and forget it. You're going to get updates. You're going to see where it's going. You need to understand the trajectory. But from a structure standpoint, I think generally in a venture deal, you should be thinking about an exit over time, not a PE style, we're going to turn and burn, put a bunch of leverage on it and roll out in 2 or 3 years, but over time, seeing if they can compound your equity at a high rate, because that's what we're trying to do here, right? We're trying to compound equity at a high rate. And as long as they're doing that, man, let it eat. Let it eat. So typically they're not structured as pass-through, and you're looking for some sort of an exit. And asking a founder what the exit is, it's a very thought-provoking question. It's a great question. Just don't get too hooked on the answer, because they're just predicting the future like anything else. So Elysium might be a good example here. They could exit several different ways. Honestly, any of them are going to go great for the investor. Elysium is 2 people. Their burn rate is incredibly low. So when we finish the existing round that is open right now, which is very close to being closed, their runway is as long as they want it to be.
Yep.
And they can now be incredibly patient with knowing whether they're doing milestone deals, licensing deals, full-on exits, whatever it may be. And that's really part of why YouAre Launched exists, is to give founders the runway to think about the company on something other than just cash flow.
Yeah.
Right? Because that is such a hard thing to always only be thinking about. So, just understand that you're putting something in there that is trying to compound your equity at a high rate over time. And if you can get behind that idea and embrace the illiquidity, I think it's a really good way to invest.
Yep. Okay. Now, would you, for lack of, or maybe to oversimplify it, kind of equate this as like investing in businesses?
It's exactly what it is.
Okay. Just want to make sure I'm not making words up.
Yeah, it's exactly what it is, Jared. And I think one of the things we're really sensitive to, and bear in mind, when we come and do this, we are putting ourselves in the position of the investor.
Yep.
Not necessarily the founder. We align ourselves with the founder, but we're looking at this with our own money to invest in it, right? And so one of the things I'm looking for is a really simple capital stack. Really simple capital stack. So I can come to you and you say, what am I buying? You're buying common equity that's exactly the same as Greg and Tom's. So Jared and Greg and Tom, they get paid the same day, same time, right? That's very important to me. It doesn't have to be that way. I'm okay if investors that we bring in come in a preferred spot. But to your earlier example about the pickleball, you came in a secondary spot, and whether or not that was written to the docs is kind of irrelevant. But they subordinated you without you even agreeing to it. Not okay.
Yep.
So we're never going to bring investors into a position that we think subordination in that way is ever possible. So we want to have an extremely defensible capital stack position where at the very worst, they're getting paid the same day as the founders, at the very worst.
Okay.
And in some cases, like they come in preferred, right?
Yep.
But that's not always necessary. We're here for the founders as well. Absolutely. We work with them every single day, so they have to know that. But in general, if we're offering common stock that's exactly the same as the founders, we feel good about that.
Yeah. Okay. All right. So let's start towards wrapping it up, right? I know you've got to drive back to Austin tonight, but all right. So if you had to wrap this up into a couple of the key takeaways. So someone looking at investing in startups or businesses, and really the businesses you're investing in they're not cash flowing businesses. It's not like, hey, I'm going to partner with somebody and fund their AC business that's going to throw off cash flow in 6 months. These are typically the cash flow comes from a liquidity event.
I think there's a variety in there. Renew will be a cash flow business very soon. Firebox is a positive cash flowing business. It's not necessarily passing it through, but
and I mean pass throughing to the investors. Yeah.
I think we have an interest in supporting businesses that might already be cash flowing that says, man, if we had an extra 10 or 20 million, we could really expand. We would need an incredibly compelling expansion case to do that because you're right. We've done mostly venture style. But we would be interested in that type of a deal. Mm-hmm. We just haven't really done it. It's just not been what's out there. And, there's other options for those folks. Sometimes they can do PO financing or, collateralize some assets for some lending, stuff like that. I think there's a big opportunity in that space. Mm-hmm. We just haven't really done it. So, wrapping up a few of those things, I just go back to the ethics thing and the talent. Look for that person who is just 1,000 times better than other people in that space. The Pringle story is a good example of this. I'm sitting there, the gentleman that I know is to my left, and he looked at me, and I could tell that he probably knew I didn't really know what was going on. And he looked at me and he said, Isaac, I thought I was a great software architect. This is a very serious human being.
Mm-hmm.
Until I met Sudhir Sacha, and I realized I couldn't hold his water. Wow. That is quite the statement. Those are the type of people we're looking for. So look for that superstar talent and people who would not steal from you even if they knew that you would never know. Just ultimate integrity. Those are a couple, I mean, really first principles that we're looking for.
Yeah, no, that's great. And I think sometimes you really do, and I'm thinking about some of the other, interviews and some of the other asset classes that we've talked about, and you really do get some like very specific things that you should be looking for in different specific asset classes. Mm-hmm. But those are much more predictable asset classes, or they're real estate, and so really when it comes to something that I have no operational experience in an agricultural equipment business like Firebox, right?
Right.
I have zero. So what can I do? And you're talking about fundamentals.
Yeah.
Fundamentals. Are they trustworthy?
Yeah.
Are they talented? And you've said it as well as like who gets paid when?
Yeah.
How's the incentivization structure?
What does the basis look like? I mean, that's really important because I look at something like Elysium and I look at what they're asking and then I go and I compare it because I do a lot of biotech investing on the public markets where you can see very clearly what everybody has. And I think that if they were public, it's kind of a biotech bear market right now, but if they were public, I think they would be worth 15 or 20 times what they currently are. I think it's worth $1 billion what they have. So compare it. Find a way to compare and contrast the value that you're paying because basis is forever. And a venture investment is just like real estate where, and there are some real estate people who argue with me that there are various things that you can do to change your basis. And I'm like, yeah, but it's still forever.
Yeah,
it still is. What you pay for something is the greatest determinant of whether or not you will make any money.
Yeah.
And so, look at this and compare and contrast.
You make money when you buy.
You make money when you buy.
Yep.
Yeah. Compare and contrast to see what kind of a deal you're getting and make sure that the deal you're getting is kind of a no-brainer.
Okay.
Because one of the things that I see is I see some people with some really compelling assets and they're like, yeah, we're raising $5 million at a $3 billion valuation and we're going to double your money and we're going to go to $6 billion. And I'm like, not worth it.
Then why do you need $5 million?
And you'd be surprised how often I have somebody come to us with a 10-figure valuation. They're just certain that it's a good deal for people. I'm like, okay.
I looked at a gold mine. Yeah, you're laughing already.
You know what a gold mine is, right?
Money pit?
It's a liar standing next to a pit.
That's great.
Yeah.
So, introduced from a friend who is invested in it. I hope it goes well for him.
It might.
Me and a buddy, which I think you know him as well, we flew out to Phoenix to go look at this. What from their paperwork said this could be the largest gold mine in the world. Mm-hmm. And so we go out there, he drives us around, and shows us all around and gave us the story about how this other mining company, they got their readings and it, basically it's a different type of gold formation. This is their story. This is a different type of gold formation than they even knew about when they did these core samples. So they thought it wasn't a good spot. Well, now we know more and we think it's this other type of gold formation and it's awesome. It's going to be amazing. But when you look at the valuation, they could sell for less than the valuation and walk away with millions based on what was raised because they were selling working interest at lower than the valuation.
Exactly.
So
capital stack problem.
Yeah, the capital stack problem. So I think their valuation was like $20 billion. And let's say 20 million. I'm making numbers up right now.
Sure. Yeah.
Valuation was 20 million. They were raising 2 million.
Yeah.
But since it's working interest, you didn't get paid back first.
Which is also the structure of most oil and gas deals.
Yes. So, but most oil and gas deals are probably more likely to work out than the gold mine.
Oh, for sure.
So that was ultimately whether or not, and then there were some ethics concerns. There was some, some truth telling concerns. There were some lawsuits we found. And
liar standing next to the hole.
Now again, he had answers for all of this. I was with a buddy, and we were asking tough questions.
Yeah.
There was an answer for it. And basically it was like, well, if we write this check, we need to be like we need to write this money off entirely.
Yeah.
Which is kind of what you're saying on some of these deals, but it's a very different scenario when you're like, well, this guy's already been like sued.
Yeah.
Okay. He already has a business that's not operational in the same area.
Right.
And he has to tell a really long, convoluted story to sell the gold mine.
Yeah. And I think you're making an interesting point. You touched on something there. I presume you decided not to invest.
Correct.
But you did go see it.
We spent an entire
learned
day.
a lot.
Yep.
And I think
it was a great experience.
Yeah, I think,
and one of my cheaper lessons, only the cost of an airline ticket.
$1,000, and you've probably saved $100,000 or something. I think going and seeing things is incredibly important.
Yeah.
For instance, if you go to Valdosta, Georgia, and look at our pyrolysis equipment, it's incredible. But if you didn't do that, and we were lying to you and telling you, oh, we do this thing, and it didn't exist, you're going to lose all your money. And I've seen that happen on a number. I have a bunch of friends who were in a deal. I was in a deal that the technology they suggested they had did not exist. Literally did not exist. And it's a Ponzi scheme.
Yeah.
And there's so much more out there of that than they realize. But mining in general, just for the record, is the worst business in the world. I do mean that very literally.
Okay.
The hardest, the worst. More money has been wasted chasing that than there is. And I actually invest in mining on the public markets. But
public markets, yeah.
But that's where my background is. It's a very specific thing. So there are some interesting exploration companies out there, but I would never invest in a private placement.
A private placement, no. single mine.
No chance. No chance.
Yeah, it was exciting. It was like, oh, think about the returns, and it was also about like they're not incentivized. They could just sell it for their valuation, and we make our money back.
Well, and you're also it takes decades to get a mine up and running. Like the returns there are just they take forever.
Yeah. Yeah.
Very challenging.
Okay, so let's wrap it up with one of my final questions. I always say my last one, and there's always more, so I'll say one of my final questions. Give me some red flags in the documentation that investors should be looking for in the general type of stuff that you operate in. So if they're looking at yours or looking at other guys, what's the red flags they should be looking for?
I think most of them are related to capital stack.
Okay.
It's managers that have too much latitude to do things like they did in the pickleball deal.
Yep.
Where it's like managers can, at their discretion, bring in tranches of money that are, that subordinate existing classes.
Preferred equity.
Oh, they can bring in preferred equity at their leisure. They can do this. They can borrow from this deal to go commingle, which is never legal, but they'll write something in there that says they can do
or
that.
Or they'll technically commingle, but it's not technically commingling, but effectively they'll do that.
Absolutely. I think things that you don't understand are a red flag. It's just get some counsel, understand what they are. Our documents, sometimes people complain about the length of them, but they're professionally put together for a reason.
Yeah.
So I think looking for that, look for documents that appear to be copy and pasted from another deal, because then there's very little attention being paid to them. And they're just trying to maybe shoehorn something that doesn't belong there. So I think that's there. Again, being very careful along the capital stack, the other investors taking a look at it. We could probably do a whole show just on the documents themselves.
Oh yeah.
But make sure that everything that has been illustrated in a pro forma or otherwise, a deck, a slide deck, transposes correctly over to the new series of documents. The things I don't get people down for are typos on titling or names or anything else. Like, for instance, we have titled 75 different investors in the last week. That's a lot of work.
Yeah.
There are typos. There's a lot of work being done very quickly. So be patient with operators on stuff like that. But just be thoughtful about the provisions that you don't understand. And, this is where AI is really helpful. You see a provision, a tag-along, drag-along clause. You don't know what that means. Grab it, put it in there. What does this mean? They'll give you a layman's terms, and then you'll go, oh, okay, makes perfect sense. I have the right to tag along with them if something happens here. So I think that there are some things, but in general, it's just looking for the professionalism of your operator and making sure that they're not trying to pull one over on you with what they can do,
Okay. I love this because about half my guests now bring this up without me saying anything. But using AI or ChatGPT, if you're new to that, go download my guide on how to use ChatGPT due diligence. That's good. Yeah. So, but yeah, it's so fast. It's so simple. It's so easy. And like the amount of education at your fingertips
it's crazy.
Is insane. Because you just ask it a question. like I don't even type to ChatGPT anymore. I press the speak button and I speak to it, and then it just transcribes it, and so makes it so easy. That education that help. You don't have to go Google for terms anymore, and so yes, that's great advice.
Yeah, and I'm seeing it become popular for people to be like, look at this terrible answer, ChatGPT. And I'm thinking that's the wrong way to think about it, because they're like 97% accurate, which is more accurate than you or I am.
Yeah.
And they're largely they're biased, so you have to be careful on the bias, but they're largely very good. I will tell you the area that I'm using it for. For instance, I put in the recent act related to cryptocurrencies into it. It's hundreds and hundreds and hundreds of pages long. I would spend a year reading and going through it, and I said, give me the 3 points as to how this relates to Ripple, to XRP. And it gave me 3 bullet points, and in each of those bullet points were like 14 more bullet points. I'm like, that's cheating, GPT. But it summarized for me, if this happens, here's why this is impactful for it. I mean, it summarized this thing, and my knowledge went up 3 or 4x in like 45 minutes.
Yep.
From something that if I'd read the actual piece itself, I probably wouldn't have learned anything because it was over my head.
Yeah, too much.
But man, if you're evaluating public equities or you're evaluating new legislation or something like that, it is incredibly powerful.
I think about the people who made millions and millions and millions and millions of dollars because they were early on the PPP or the employee retention credit, ERC.
Mm-hmm.
The ERC. Mm-hmm. There's first person in the space and just exploded because they understood how to do it and how to help people do it, right? They provided a good value.
Oh, great service. Yeah.
Great service. Yeah. But the ability to use ChatGPT to figure out what's changing in the market. Where's the government pouring money, and let me stand over here.
And things are changing rapidly.
Yeah. Was it what happened to Penny Candy? Have you read that book? What is that book called? I read it and forgot. It's small.
Pennywise is the clown, right?
Pennywise is the clown. You're right. I've seen that. They're doing another movie. I'm seeing these commercials all the time.
El Paso.
What happened to whatever happened to Penny Candy or something? It's got a little sailboat on the front. And one of the things it talks about is like government creates winners and losers
for sure
by pouring money places.
Yeah.
That pours and pours and pours until it doesn't anymore.
It's capital flows.
It's capital flows.
Yeah. And it's regulatory capture, and it's a massiff problem.
Yes.
But it's also something you need to be
But if it's going to happen anyways, this is what the book talks about. It's like, hey, I hate that government does this.
Yeah.
But government's going to do it anyways. How can you benefit from it?
Oh, Jared,
understanding.
That's an important point, is because I see a lot of people, and I find myself doing this, so I don't want to like blame other people. I find myself getting upset about things I don't like. And then I'm like, literally, I have zero control over how much money they're going to print, how much debasement they're going to have.
Yep.
Zero control. How do I help my investors and my friends and my family and myself take advantage of the rules that they're writing? Because me
and you aren't writing the rules.
We're not writing the rules. I'm not getting into politics anytime soon. And so you better figure out what they are. And then play that game.
Yeah. At the very least, you got to understand them.
You got to understand them.
So, okay. Isaac, why don't you tell us, if you want to, what deals are currently in the works for you, how people can get a hold of you, what you got for us?
2 things that I would say are in the works. Renew Environmental, the plastic to oil pyrolysis. That is the most just crazy, just analog business ever. I joke that we should change it to just Renew AI and then just say there's like AI in the oil or something. Because people are like, wait, you're doing what? And it's just incredibly potentially lucrative. So that's a deal that has an open round. We actually have a term sheet to close that up right now from somebody, but at the moment it's open, and I think it's a phenomenal opportunity. Does a lot of good for the world. The other thing we're doing is we're putting together an AI data center land fund, which is basically preparing land for a data center to go on top of it. And that's sort of a sit around and wait for a while for something magical to happen and then get paid a lot of money to do it type of deal. But we like the defensibility of it because the underlying asset is land, right?
Yep.
And so we think it's a very defensible investment fund. I've actually been very critical of funds in general, just because I don't like the idea of collecting a bunch of money to then think about buying something. But in this case, we have 5 deals already, and I just don't want to go out and do 5 different syndications to raise money.
Yeah.
That's very challenging. We're pulling them all in and saying, this is an evergreen fund. This is what we're doing. So those 2 things that will be open soon are kind of open things that we have out there. Is that what you meant by that question?
Yes. No, okay. I want you. This is your one. This is your actual chance.
Yeah. Those are the 2 things
to pitch yourself.
Yeah, those are the 2 things that we have open right now.
Okay.
One on the venture side, one on the land side. And then to reach out to me, it's just my email is the best way. My name, ISAAC, Isaac, at apeoplebrand.com.
Apeoplebrand. All right. We'll have that in the show notes, in the description. We'll have your LinkedIn available.
Sure. Yeah.
All right. So, Isaac, this has been great. I always enjoy hanging out with you anyway. So I'm glad I got some dedicated time. No one else got to come and interrupt you and try to steal you from me to say hi and talk to you. So, man, thanks for being here.
Thank you for having me, Jared. It was so much fun.
Great.
Yep.
Okay, so I hope you enjoyed that conversation with Isaac as much as I did. We covered a lot of topics, and honestly, it's what he does is fairly different than a lot of syndicators and fund managers. So we touched on a lot of topics generally. We covered some stuff that was just a little bit different than normal. But I think that really, no matter how weird or how different or how novel an investment is, you really can take it down to really that fundamental level of ethics, of trust, of incentivization. How does this make money? How does this lose money? So thanks for being here. If this is your first time on the channel, make sure you hit that subscribe button. And again, if you're looking for some help doing some due diligence, download that guide on how to use ChatGPT for due diligence. And until next time.